Welcome everybody. This is Mel from Aka Science to Trader. Again, it's a tremendous opportunity to be presenting webinar number 2. If you knew the journey I had to undergo to get this second webinar out, it was even more painful than trading. I conducted or constructed what I thought was a presentation, only to find out after 45 minutes that the software that I'm using was actually utilizing by default the inbuilt audio microphone for the laptop rather than the external microphone which I bought, which supposedly cuts out a lot of the interference, which it's supposedly doing now. But if you had heard the first take of webinar 2, it was actually worse than last week. So thankfully I didn't actually go on even further and managed to get things in motion, and my voice is back on track. So hopefully the combination of my voice being on track and having a proper microphone should make a big difference to the quality of the output for this week. Thanks for all your comments. I do appreciate the comments coming back about webinar number 1 and all your guidelines and suggestions of how I can enhance and improve. Today's webinar should not be more than 1 hour. I have a stopwatch here, so when I get to that hour mark, I do realize that there will be a need to close things off and hopefully make this a webinar which is slightly shorter than last week but more spicy, as I've got a number of dynamic features to this webinar to kind of help spruce it up. Probability theorem. This is the lifeblood of technical traders as myself. Probability theorem, without it we wouldn't survive. It's the infrastructure, it's the scaffolding that keeps us in check and keeps our mindset in check and keeps our trading strategy in check. Without probability theorem, I'm very much like a tree that's been tossed around with the onslaught of a tornado or hurricane. Probability theorem is the foundation of what I do. And today's webinar will hopefully give you some insights into how probability theorem can influence you in a positive light, but also some of the dangers of probability theorem as well, because of the fact that it can actually bite you like a viper hiding behind you in the grass. So I wanted to touch on some of these issues. Before I do that though, I got an email 2 days ago, and I looked at it and I thought, here we go again. This is exactly what I was talking about last week. It was sent by somebody who supposedly I must have signed on to their mailing list or to their email list, but they sent me a notification of a webinar which they're doing, and the title was a system that generates a 90% success rate. And I thought, here we go again. This is exactly what I talked about last week. And if you're a trader that's new or starting out, or a rookie, or even somebody that's simply just desperate to generate some profitability trading, then these are the types of marketing headlines that kind of suck you in hook, line and sinker. And if you did miss webinar number 1, I did go into a lot of detail about why high win rate systems may not necessarily be the holy grail or the pot of gold that you may think, and that there's a big difference between what we are accustomed to in life in terms of associating anything with a 70% or more win rate as something that's proof of success, whereas things which have a far more significantly lower win rate we associate as things that are typical of non-success. And that's, as I said, born out of the educational system that we are used to. And again, see webinar number 1 where I do touch on that quite a lot. In terms of a recap of last week, well, as I said, we talked a lot about win rate and we talked about reward to risk. and how there's a balance or a relationship between win rate and reward to risk, and really trying to identify what is the perfect balance that works for you based on the personality profile that you have, but also in terms of the expectation that you have in terms of profitability and in terms of your ability to deal with losing streaks. In fact, what I wanted to do right now is actually just play you a very, very short clip from two people who are people that I follow, where they actually talk about this particular concept of win rate and reward to risk, because I want you to hear it not just from what I'm saying, but from what other people are saying. And these are people that are, very, very successful financial traders. So let me go to the first one and let me make sure that my technical things are working as far as this is concerned. So let's go now. Let's see how this goes. And that didn't work. Let me start again. So this is Charlie Burden. Let's hear what Charlie Burden has to say about win rate and risk reward.
I'm only right maybe 50% or so. And most of the trading that I do these days is sitting at around about 50% or so, maybe 50 to 55% win rate. Some intraday trades have a slightly higher win rate than that, but certainly on my swing trades, I'm only right maybe 50% or so. And people would say, well, that's a really bad strike rate, Charlie. I don't care, because to me it's about risk to reward. So if I'm risking 1 to make 2 or make 3, then I can afford to be wrong 50% of the time. I can afford to be wrong 40% of the time, and I'm still going to be making decent returns. So, but I always say, for newer traders, they have that desperation, that need to be right as much as possible. Newer traders don't want to be right only 50% of the time, because it means they're wrong 50% of the time and they can't handle the losses. So I get that. But what most people find is that as they become more experienced and they develop a thick skin, then you shrug off the losing trades a lot, and you don't mind those, because you can take have lots of little opportunities and to find trades. Some of them aren't going to work out, but when the ones that do work out, they make so much more than the losses you have, then it doesn't really matter. But it's easy to say that in theory. In the thick of things, when you've just had 5 losing trades in a row, for a newer trader, it's difficult for them to cope with emotionally. But as you develop as a trader and you've been around for a number of years, you get so used to that.
So that was Charlie Burden talking about the fact that his particular trading system only wins between 50 to 55% of the time. The other thing that I wanted to play to you was from another organisation which does a lot of great work in terms of helping people to understand the statistical components of their trading strategies. So I'm going to play this clip, which is going to be about 3 minutes long, but again, it just demonstrates and conveys there doesn't need to be such a fascination and focus for high win rate strategies. And what we're going to show here are a number of results that they get from trading systems that they utilize, where the win rate is nowhere as high as 60% or even less. So let's see.
Just because it would be a good example to kind of show you. And I would ask you a little bit, how does this look to you? Winner, loser, winner, loser, winner, loser, loser, winner, winner, loser, winner. It doesn't look that great to me. I mean, if you just kind of look at that and say, hey, here's my trade system. Look how I did on my last, 11 trades or whatever this is. It's not that impressive, right? I mean, it has 1, 2, 3, 4, 5 losers. I don't know, what is it, 1, 2, 3, 4, 5, 6 winners. I mean, it's barely over 50-50, like I mentioned. But this series here in Keltner Bells recently was good for plus 515 pips, all right? And this was actually on the Euro New Zealand. And here's why. Because notice the winners. Now, not every winner is huge. Not every winner is the full target, which is the 159, 160, 158 target. But notice a couple things about how this works. The losers, in general, tend to be quite a bit smaller than the best winner. If the best winner is 160 pips, you can tell the average loser here, besides one that lost 120, is about 30 to 40 pips. So the winner is almost 3 to 4 times the size of a typical loser. That's why I can go 6 and 5 and have a great bottom line. 515 pips over a series of recent trades, that feels really good. I didn't have to be perfect. I didn't have to win 80% of the time. I didn't have to put all kinds of pressure on my system going for tiny, tiny targets to win 80% of the time. Or what's worse that a lot of people do, they risk a ton or they don't even trade a stop in the Forex. That becomes, a problem. I see one comment here from Did We Start No Video? I guess 921. I'm assuming nobody else has that problem. I'm going to put a little thing down here in the chat. You need to refresh. So you just probably need to refresh your screen and hit play. So hopefully that'll take care of it. All right, and that nobody else is experiencing the same issue. All right, so let me just close you guys don't see that in the way. First 3 of 4 losses. So here's another set of trades. Winner, loser, loser, loser. Now I ask you, would you quit after the 3 losses? I guarantee you the majority of this room here would quit. Is that being mean of me? I'm trying not to be mean. But it's just the reality. Most of you will bail out really quick. When I say 3 out of 4 of you will quit, I'm actually complimenting you, right? Because that's 25% will hang in there when the typical success ratio is 8%. So I'm saying you guys are triple the success rate, right there. So it's not meant to be mean, but it is true. We have these calls and these emails all the time. Troy, who's not with us today, he'll tell you all the time. He runs a live room, the hardest thing to do in the business, right? Especially with new people. And if the first trade or 2 loses, oh my God, it's like the end of the world. It's like it's never going to work for them. Well, what if you lost, like you see here, 4 of the first 6? I'm telling you, what if you just started Keltner Bells right there in that sequence? A lot of people will bail and will quit. But look what happens after. Win, win, win. That series of trade, again, I'm not trying to pick out our best sets of 10, 11, 12 trades. That's easy to do. I can show you 10 winners in a row. I'm trying to pick out sometimes the worst sets of trades. Good for 291 pips. What market? It was the pound CAD. Again, it's the same theory, is that the winners, 130 pips on average, you got a few partial winners, and you got some losers. And yet, granted, you got a couple losers that hit full stop out for us was that 78 pips. But you had one that lost only 8 and one that lost only 14. And then I'm coming back on a full win and picking up 134, 133 pips. So not a great series when you think percentage-wise of win-loss, right? Not even at that 65% that we expect to achieve over time, but still a really nice result. What if you started right at a drawdown? What if you traded a market? This was the franc yen. It had a position or a time where it lost the first 3 in a row. And not only that, almost every time we lose on Keltner Bells, we have a partial loss. For some reason, these 3 losers in a row were full stop outs. It was just the market was kind of crazy whipsaw. And again, a lot of people, most people, I guarantee you the majority would quit. You know what happened the next set of trades? The next 10 straight trades had full or partial winners, plus 475 pips. So I'm trying to really convince you here not to get obsessed with win-loss percentage, okay? Be obsessed with following your plan. Be obsessed with sticking with something that has proven itself to be profitable. In the case of Keltner Bells, it's for 3 years, all right? And I'm trying to be really honest and upfront with you, unlike most other people in my business who just talk about winners. I mean, we're spending an awful lot of time, Brian and myself here, talking about losers because I'm trying to address probably the smaller percent of you who kind of really are going to be serious about turning this into a profitable business and not looking for something that's going to be perfection, holy grail, and get rich quick, because that just doesn't exist in trading. One final example that I'm going to hop over to a chart is the Euro Aussie. Okay, and the Euro Aussie, I wanted to just again show you something here. Same thing, right? 1, 2, 3, 4, 5, 6. What was it? 1, 2, 3, 4, 5, 6, 7 winners, 5 losers. 58%. Below again the 65 that I really think we should try to shoot for. But the same thing again. Notice I had 4 full wins, all right, and 3 partials. On the loss side, I didn't have a single one that lost in full. They were all partial losses. So by having 58% winners and a damn good ratio when it comes to my average winner to average loser, I pull in almost 300 pips on a series of trades without having to be perfect, without having to be right all the time. In fact, being wrong almost half the time. All right?
Okay, so hopefully that just gives you a bit of an insight into how some of these people tick. Um, it's just the nature of the industry that we always tend to want to go for high win rate systems. But a lot of these guys that I follow and others too will tell you that their win rates are barely breaking 60%, even 50%. So for me, that was where my journey started in terms of understanding, well, why is that the case? And it led me to then finding an edge that I could find, which kind of synchronized with a lot of the concepts that these guys are talking about. Last week, we also talked about Monte Carlo analysis and how Monte Carlo analysis is one of the most important tools that I use in order to be able to backtest, to run trading simulations and give myself a indication of how likely a particular strategy is going to bear out over time. Now, last week when I did the Monte Carlo, what I did a comparison of a high win rate system, which I believe it was like an 80% win rate system, where you were risking 3 to make 1. And I think I used an example of some of the types of strategies that I see out there, certainly in football trading, where focus seems to be on getting as many small winners as you can, even though when the loser comes, it can wipe out a lot of those small winners. Somebody asked a question last week. The graphical representations that I created, were they picked at random for the 80% system and the 55% system? So what I'm going to do, I'm actually going to try and do a live demonstration to show you that I wasn't just cherry picking to prove a point. So basically, let's just say that we've got somebody that's got a bank of 5,000 euros and they're doing, let's say, a typical football trading strategy, one where you back over 1.5 because of the fact that most games will end up with more than one goal in a game. So you kind of think, well, if I do my stats correctly, do my homework correctly, I will back over 1.5 because it's something that happens most of the time. Now, at the beginning of a match, the price on over 1.5 would normally be around 1.25 to 1.3. So let's just say it's 1.3. So if you back it with £100, your liability is £100. That's your risk, but your profit would be £30. Yeah. So basically, you're risking £100 to make £30. But some use the argument, well, if the win rate's, at least 80% or more, then at least you will be profitable most of the time. Well, let's check it out. So if the win rate is 80%, you're risking 3 to make 1, or you're risking 0.3. You're risking 3 to make 1, which in the reverse is a 0.3 to 1 reward to risk relationship. Let's run this for 100 trades, and let's run this as 2% of your bank. So basically, as the bank goes up, the size of your trade goes up. Yeah. And if the bank goes down, then the size of your position sizing goes down. So 2% of your bank at any time. So I'm going to click Start Simulation, and I'm just going to keep clicking on it. Yeah. So right. So here we go. So I'm not cherry picking. As you can clearly see, it's a highly volatile trading system to be following. I mean, there are instances where it does go up, but look at the amount of times it goes up and comes down. It's very, very volatile. If you look at the the zigzags, I mean, it clearly shows you that it's a very, very volatile system. Yeah. Let's increase that percentage to 85 to see if it makes a difference. So 85%. So when we hit 85, then it seems like 85% is where it starts to look like it's improving in terms of its performance. Yeah. But the key thing here is, I mean, to get an 85% or 90% win rate, I mean, your match selection skills, I mean, it puts so much pressure on you, because if there's a little dip in performance where it hits 90 and goes down to 80 or even 70, then you're basically stuffed. And okay, even if it's at 85%, let's look at, well, how much does it really rise after 100 trades? And it's barely sort of clearing, 6,200. So it's barely clearing an additional 1,000 euros profit. I mean, it was just a 7,000 euro there. But as you can see, with 85%, then you're looking after 100 trades, probably making around 2,000 euros profit. If I change it to 55% and I change the reward to risk to 1.8 to 1, which is what my target is. Here we go. And again, I'm glad I'm able to do these live demonstrations, because it just shows you that I wasn't cherry picking last week. I mean, nearly most of these simulations are showing you that it's a consistent upsloping equity curve. And I mean, look at this one. I mean, it's basically saying that there's the potential to grow it from 5 to 22,000 euros after 100 trades. Here, 12,000, 16, 18. I'm just looking at what that top figure is going to be. 12, 24, 18, 11, 16, 22, 18, 14. So compare that to what we were looking before with the high win rate system, where it was barely clearing 7,000 euros. So the point of this is really to show you that not only is it an upward sloping equity curve most of the time, but also the power in terms of the profit potential. Now, somebody sent me an email asking me about, is it okay to trade a system where the win rate is around 70% and where the reward to risk is about a 1-to-1. So let's check this out. So you've got a trading system which has a 70% win rate and where the win-loss ratio is about a 1-to-1, which I think is probably consistent for most exchange systems, whether it's Betfair or the Nasdaq or the S&P or even the FTSE. Any sort of financial exchange system, the relationship between the win rate and the reward to risk tends to be quite consistent across each exchange, in terms of the fact that as your win rate goes up, the reward to risk goes down. But I know certainly if you're dealing with a system that wins around 65 to 70% of the time, you're probably dealing with a reward to risk which is about around 1-to-1. So let's see how this goes. So with a reward to risk of around 1-to-1, you can see that most of the time it is an upward sloping equity curve. Most of the time it doesn't generate as much as a lower win rate would be, where I was doing 55% with a 1.8-to-1, but the profit potential is still pretty good. Yeah. So the decisions that you make, it's really going to come down to what your expectation is. I know some people would be happy with a 70% system, which has a reward to risk of 1-to-1. But these can be sometimes awfully difficult to find, and that's why sometimes you might have a situation where you think you have a 70% system and then it starts operating like a 60% system. So you really sort of have to do a lot of testing and work out what is the true win rate for what you're doing. And the only way you can do that is really by, I would say, doing at least 100 to 200 trades to get a sort of real consistent idea as to what that win rate is going to be for you. I mean, there will be obviously fluctuation, but certainly, as you can see, a 70% system can bring you some good profits with 1-to-1. And that's why I was saying last week that I wasn't trying to imply that a sort of low win rate system like what I work with is the be all or end all, because people can make good money dealing with a 70% system which is 1-to-1. So it really is all about what is your comfort factor, and all I'm doing really is just giving you ideas to add additional arrows to your bow. There are people out there that might be have tried everything and they're really just desperate to try something that's completely different, where what I talk about actually provides another channel that they can exploit. Others of you might be already happy with what you've got, where you're dealing with a system that has a higher win rate, and so there's no need to take on the types of concepts that I'm talking about. So again, what I'm trying to do is just give some ideas, but it's not the be all or end all. But certainly for myself, when I was chasing high win rate systems, I just found that over time, dips in performance would really impact me significantly in terms of income. And if I did get into losing streaks of losing trades, it would take a longer time to recover because of the fact that my reward isn't greater than my risk. Whereas with a 55% system, or a 50% system, or a 60% system, what you find is that if your reward is at least 1.5 times greater than your risk, then when you do have losing streaks, you can recover back to break even quite quickly because of the fact that your reward is greater than your risk. So just wanted to make that point clear. So let's go back to the presentation. We also talked about trading parameters, and last week I sort of gave you it was almost like a script of the types of parameters that I abide by. Now, what I wanted to sort of mention was I think I talked about how in terms of price, I go in when price is sort of around 1.6 all the way down to 1.2. And the 2 points that I wanted to make in regards to that was just a point of clarification. When I'm going in at that particular price, what I'm doing is laying. So essentially what I'm doing is buying low when price is low, so that if things happen as I want them to, then when price shoots up, then I'm selling high. So buying low and selling high is basically how profit is generated. Certainly if that's the way that you're opening and closing your trade. So that's the first point I wanted to make. I'm not backing or selling. I'm actually laying or buying when price is low. And the second point I wanted to make was in regards to the fact that what I don't want people to do is get so prescriptive in how they take my information. It's not necessarily about the information that I'm trying to present, obviously the way that I'm trading a lot of the times is where I'm looking for late goals. But I don't want people to lose sight of what the fundamental concept is. It's not so much about late goals. It's about going in when price is low. So you could have a strategy which has nothing to do with late goals, but it still is a strategy where you're going in when price is low because you found an edge whereby going in low and risking less to generate more, you found a niche, you found a comfort zone, you found an edge where the win rate that you've discovered is able to sustain a positive expectancy. And the reason I say that is because I received a question yesterday in regards to a trade which I made, and this trade, let me just try and find this particular trade for you. We'll go to results, trading results. So this trade was one it was yesterday. So the trade was this particular one here, Deportivo Saprissa versus this team. This was in the Costa Rican League. What had happened was I was working on webinar 2 quite late, and it just so happened that working into the hours of the night, I was aware that there were 2 particular trading opportunities that I could take. Now, I don't necessarily trade late at night because normally by 11 o'clock I'm sleeping. But because I was up late, obviously, if you're up late, then you've got access to a lot of the South American leagues and the North American leagues that sort of kick off in the late hours of the night. Now, what happened, Deportivo Saprissa, this particular game, it wasn't a late goal game. Yet I made £337. So somebody actually asked the question, well, how can this trade be a trade for me when I trade late goals? And basically my response is that even though late goals is pretty much the majority of my portfolio, I always think it's good to have other arrows to your bow. And one of the arrows that I've been looking at over the last sort of couple of weeks or so is looking at goals within the first half. Now, this particular game, what happened was the algorithm which I use had identified this game as a game with a very, very high potential of goal output, just based on stats, etc., blah, blah, blah. And also the way that the game started off, the momentum from the first 5 minutes was showing that this is a game that is possibly going to have a lot of goals. But what happened, it got to 23 minutes and it was still 0-0. So what I decided to do, I thought, well, let me go in and place a trade. And what had happened, the price, the over 2.5 had actually started off at evens. I think it was about 2, which I thought was actually a bit strange, considering that this was a game with high potential. Because normally, if you're looking to lay a game which has high potential of goals, normally at the beginning of a match, then the under 2.5 would normally be around 2.2, 2.4. It wouldn't be evens, but it was even. So I thought there was already some good value here. And what happened, I placed a lay. So price had actually dropped at 24 minutes. The price on under 2.5, which basically means, what I'm looking for is to lay it, because I don't believe that the match is going to stay under 2 goals. So what happened, the price had actually dropped from 2 all the way down to, I think it was around 1.5 or 1.6 or 1.5. And so what I did, I laid 1.5 or 1.6. Can't remember what it was exactly, but I laid it around 1.6 for argument's sake. So again, what I'm doing here, I'm going with the same concept of laying low in the expectation or buying low And the reason I keep changing terminology is because I'm aware that there are some people on the webinar who are financial traders, so they're not used to laying back, they're used to buy and sell. So what I did, I bought low in the expectation that gold would come where the price would rise from 1.6 back up, where I could close the trade and make profit. Well, what happened? Well, the gold came on the 25th or 26th minute. And I could have closed the trade for profit, but I thought, let me just hang on. And then within another, I think it was within another 5 or 7 minutes, another goal was scored. So 2 goals had been scored. So price, it shot up significantly. And then I closed the trade. And that's how the profit was generated. Now, what was quite funny was that in the second half, there were no goals scored. So it actually ended up with just the 2 goals in the match. And that is, again, one of the reasons why when it comes to trading, it's important to understand that things may not necessarily go the way that you expect. So it's always good to close out for profit where you can, especially if you're doing an opening and a closure of a trade rather than waiting for the final outcome, especially if you've got a sizable profit already in your bank and that you're that you're not risking a lot by waiting for the final outcome of the actual market. So I hope that's clear. So just heading back to the presentation. So when I talk about trading parameters, and now I can't, when I talk about trading parameters, what I'm basically saying is don't be too prescriptive in thinking, oh, let me copy what Mel's doing in late goals because he goes in that 1.6 or less. Because you might find that late goals doesn't really resonate with you because you are uncomfortable in going into a trade where there's not much time left because that just doesn't resonate with you. You like to go into a trade whereby there's a lot more time left for something to happen which you want to happen. And I suppose I'm just trying to convey the fact that there are many, many other ways in terms of trading where you can still open your trade within that 1.6 to 1.2 and it doesn't have to be late goals. And that's basically something that you have to find for yourself through your research and try and identify that edge, because you might try and be prescriptive in going for late goals and find out it just doesn't work for you because you just can't seem to get the right win rate to justify the fact that you're in terms of your reward to risk. You might just find that you're trying it and you're like, well, how on earth is Mel able to get these so many profitable days? Well, that comes down to tools that I used, my analysis, my approach, my experience in operating in this particular type of way. So I just wanted to make clear to you that when I'm talking about trading parameters, it's not so much the market, it's more the concept, which is about buying low, selling high, or laying low and backing high to generate your profit, so that you're not trading in a way where you're trading where when you put on that opening trade, your liability is huge because of the fact that you're putting on a trade where price might be at 3 or 4. I just can't trade that particular way because so many things can go wrong with the exchange where it goes down or a game suspended, and things might not, or you might have a situation where game suspended because something's happened in the match, like I don't know, something's happened like there's been I don't know, an invasion of the pitch or whatever, and then or the suspension might not be lifted when it should do by Betfair, and then when they do lift that suspension and the market continues, it's actually shot past stops that you might have had in place, or it's shot past the point where you would have closed out for a partial liability, and then you'll find out your liability is almost 2 or even 3 times more than what you had anticipated. So that's why I like the whole idea of dealing with price when price is low, because it takes away a lot of that risk, and you can place trades and really, not have to worry too much about what's going to happen. But hopefully that gives you some insight. Okay, so dealing with losing days. This last week I had was a bit of a whipsaw week, and there were 2 particular days where I had full losses. And let me just go back to my trading results. So I think those particular days were so the 7th of May, I had a loss of £331. And then the following days after that, I managed to claw back for those losses. And then on Friday the 11th, I had another loss of £381, and I was like, oh my goodness. And then that was followed by by £331, then £450, then £300. Now, one of the things I just wanted to mention was the day where I lost £331. That day should not have even been a £331 loss. What happened was this trade, my first 2 trades were losses. So Kemi versus HJK Helsinki, and then Al Sad versus Al Ali were losses. And then my third trade was supposed to have been another team that began with the letter M. I think it was in the Danish league, the Danish Super League, Midleton versus I don't know if it was Norderland or Copenhagen. But what happened, because I was rushing, because there were so many things I was doing at the time, I actually went into the market, Malmo, because Malmo were also playing at the same time, and it was also with the same going into the last sort of 10 minutes of the match. And I placed a trade on Malmo. Now Malmo, there was no way Malmo would have even been considered. It wasn't part of the selection with my algorithm. But I did the trade on Malmo, and then the trade lost. And then it was only when I was doing my review, I couldn't believe what I had done. And so, because I'd reached my full loss for the day, which my daily loss maximum is £300, I couldn't really do any more trades. And that's just a very, very tight framework that I've put on myself to limit myself from doing any more damage. Now, what had happened was the Midleton game had it was actually a successful trade, and then there were 2 other trades after that which I was attempting, which I would have done, which were winners. So ultimately this particular day would have started off as 2 losses and then 3 winners. So there's no way, I would have been in profit by probably around £200. And it was just so gut-wrenching, because for myself, when things happen which are beyond my control, I can live with it. But when it's schoolboy errors, things that are due to myself, which I know that I could have, I could have done better, or I could have not made that mistake, those are the ones which are difficult to swallow. So for me, it was important for me just to abide by my rules and stop, because I'd hit a daily max loss, even though the fact that that third trade, I shouldn't have even initiated that trade. The £381, which I lost on the 11th, well, there's nothing I could have done about that. Every trade I did was a trade that I should have done, and it was just the fact that that particular day the market wasn't in my favour. Now, I received a question which was when I had that second £300 losing day. Somebody actually asked me the question, how do you deal with losing days, or how do you deal with, losing consecutive days, or having a period of time in the week where you've lost more than one day. And what I wanted to talk about was really probability, because the way that I deal with losses is by knowing that I have an edge, and I know that my edge over time will be profitable. And it's really important to understand that it is a game of probability, and that you cannot win all the time. And you have to accept the fact that you have no idea as to whether a particular trade is going to be a win or loss. It doesn't matter how much analysis or homework you have, you are not guaranteed that that particular trade is going to be a winner or a loss. So what I wanted to do at this point is, rather than hearing my boring voice, is put on the individual which I talked about last week, which is Mark Douglas, who was really instrumental with two publications. One was called The Disciplined Trader. The other one was called Trading in the Zone. And these books have become legendary publications within the trading field, especially in the area of psychology, because obviously when you're dealing with probability, a big component of probability is ensuring that your psychology is synchronized with probability theorem, or you're always going to have a conflict of interest between what you want to do and what your subconscious is actually trying to get you to do. So let's see what Mark Douglas has to say about probability. So here Mark's on the left, and here he is being interviewed.
Thanks. So let's get started. First of all, one of the main issues that I see all the time is that people don't use their method to its full potential. In other words, there's a negative correlation between what the trader ends up with and what he could have had if he just followed his methodology. Right. In your DVD program, you refer to this as the profit gap. This is a problem. You refer to it as the profit gap. And I think it's one of the least understood concepts of trading. Can you address this a little bit, this profit gap?
Yeah, that's actually a really good place to start, because I think that more than anything, what your viewers want or what your customers want are consistent results. They want to be able to produce an income that that they can rely on from their trading. And I'm sure that many of your viewers have already realized that getting a steady income is not such an easy task.
Yeah, and everyone seems to get trapped thinking that because trading is easy.
Right.
Or because it's easy to find yourself in a winning trade,
exactly.
Which many people do.
Right.
They think it's also easy to become a consistent winner.
Right.
And it took a long time before it actually dawned on me that winning and being a consistent winner are two completely different animals, two different things. And in some ways, there isn't even a relationship between the two.
It almost seems like there's no relationship between the two.
Yeah.
That's what you're saying, right?
Yeah.
Yeah, that's a real hard mental barrier to break through. Mainly because, it's so easy to find yourself in a winning trade, because winning actually requires no skill at all. In other words, unless you consider that the being able to click a mouse button or tap a pad is a skill, right. And we don't have to have a reason or good reason or actually any reason to put your cursor on the buy or sell button and then immediately find ourselves in a winning trade. And it could be a monster of a winning trade. And what did it take? What kind of skills did it take to actually experience this? Absolutely none.
Yeah. So it'd be natural to take the leap from, if it's this easy to win, it can't be that much harder to make a steady income. Like you said, it's that easy to click the mouse and for me to sit there and make $5,000 or $10,000, then it must be pretty darn easy for me to sit there and make a living out of this. And that's what I thought for a long time, but that is not the case.
No, and that's exactly how I started out too. And I know, not unlike a lot of other people who are willing to, let's say, give up a real high-paying career to be a trader because they thought it couldn't be that hard.
So what makes consistency so challenging? What's the big hurdle there?
Well, we're going to get into that, but at the most general level, I'm going to say that it requires learning the type of skills that people just simply aren't used to learning.
Mental skills.
Mental skills, yeah, exactly. In other words, it requires mental skills. Most people assume that because their technical method gives them a signal to get into a trade, that if the method produces a high percentage of winners, it will equate to a consistent income, not taking into consideration that the proper execution of those signals requires mental skills.
Give us an example of this.
Well, take for an example, a high school basketball player who, he'll go in the gym and practice throwing his free throws, maybe for even 2 or 3 hours a day. It wouldn't be unusual for him to be able to hit 50 in a row, would it? I mean, that's
You
not
see that all the
out of
time.
the realm of reality, right? Okay, so the problem is that could he even hit 2 in a row if the circumstances were he was in the final game of the NCAA championship, his team is down 1 point, there's only a few seconds left on the clock, and he was just fouled.
Changes everything.
Yeah, under those circumstances, without the appropriate mental skills, hitting either one of those free throws is very unlikely. And regardless of how well someone could do it in practice, most people would choke.
So really the skills you're referring to, what you're talking about, Mark, is actually staying focused on the process, staying positively focused on the process itself, in this case of throwing the ball, in our case obviously of trading or following your method,
right,
and not being worried about blowing it, about the consequences of what could happen if this trade goes wrong.
Exactly right, just like what I'm going through right now. Trying to stay focused, trying to stay focused on the process of this presentation and not blowing it.
Well, you're doing fantastic.
Anyway, with training, we may have a technical method telling us what to do and giving us the potential to generate consistent results. But like the basketball player, without developing the appropriate mental skills, it's unlikely we'll be able to do what our method, our trading plan is indicating without making a number of potential execution errors. In other words, to stay positively focused on the process of trading by doing exactly what we need to do, when we need to do it, without hesitation, reservation, or fear.
Okay. That's interesting.
So you see, no matter how good a technical method is at generating winning trades, turning those winners into a consistent income requires the ability to do or not do some things that the method itself can't help us with. For example, our method can't force us to predefine the risk of getting into a trade. Or if we do predefine the risk, our method can't force us to take the loss that ends up turning into a bigger loss.
Right.
And that's happened to everybody. Okay? Our method can't prevent us from moving a stop closer to our entry point where we get stopped out and the market trades back in our favor. Our method can't prevent us from hesitating and getting in too late. Or our method can't stop us from jumping the gun and getting in too soon, where the signal to actually get in never really develops. And our method can't stop us from getting out of a winning trade too soon and leave money on the table. Nor can it prevent us from letting a winning trade turn into a losing trade without having taken any profit.
I know that all of our traders have experienced these issues. I know they have.
And this is really good points by what Mark Douglas is talking about, because one of the reasons for myself why I didn't have any level of consistency a number of years ago was because of the fact that even though I was starting to understand what probability theorem was all about, I was having great difficulty and great trauma in trying to simply just follow a methodology from A to Z. I would have situations where I would start a particular week and say, right, I'm going to stick to this particular process, this particular model. And yet when I hit a number of losing trades, I was already looking for the next strategy. And so probability theorem and having an edge is so critical. And what goes along with that is having the right psychology to embrace it, because it's very, very counterintuitive. And a lot of people will say, yeah, they understand probability theorem, yet when it comes to the actual application of it to their trading, there's a great disparity between what they know and what they practice. Trust and belief, again, is important, and that's how I deal with losing days, because you have to trust your system. Now, I remember a couple of years ago, I read a book by Anthony Robbins called Awaken the Giant Within, and I remember he was talking about the power of belief. And I remember the way that he conveyed how a belief is formed is that you have an idea. So if you can imagine the top of a table representing a particular idea, and then he said, to turn that idea into a belief, you have to form legs for that table. so that the table then has a firm foundation. And I kind of apply that to trading in a way that in order for you to trust what you're doing, in order for you to trust a particular theory or to trust a particular model of trading or a particular way to trade, in order for you to trust, then there has to be some legs that form the foundation for what you believe. And for me, those legs were really back testing. So really, and that back testing, that's where the Monte Carlo simulations come in quite handy, because I'm able to back test thousands and thousands of trading simulations to get a real clear idea and dependable idea as to how robust the strategy is going to be. So that's trust. Trust also comes from trading in demo mode. So, you know, you're not actually putting up your own money, but you're trading in demo mode. You're kind of like that much closer to a real live environment. And then trust also comes from forward testing. So this is where you're now dealing with your own money. And so that emotional component is now a reality in terms of how you emotionally react when you're losing money or winning money. And all of these different parts of your journey are the legs that underpin the table, or they're the trust granules that actually provide that firm foundation for belief. So if you're starting out in your trading journey, or you're trying to do something from the very beginning, it can be very difficult for you to have a lot of confidence, because you haven't yet got to that point where you've generated enough trust for your idea or for a particular theory to become an ingrained belief that you can really move ahead with, so that when those challenges come, when those hurricanes and tornadoes of losing streaks come, or when those things happen that are beyond your control, where you decide to put on a trade but the system goes down, or you make mistakes, that when those particular external factors start to hit you, and they will, because you're not going to go week after week with perfect trading, there's going to be curveballs that are going to be coming from different directions. It's the trust and belief that you have and the confidence that you have in your system which is going to help you to stand against the test of those external factors. Yeah? So I hope that's clear. Another way that I deal with losing days is really just by trying to use analogies to help me understand that trading is very much like seed time and harvest time. So if you actually look at the way that a farmer actually works through the different seasons, in fact, I shouldn't be talking about seeds after what I told you about in webinar number 1, but if you actually look at the way that a farmer goes about his work, there's seed time and there's harvest time. So if that farmer, if he actually plants seeds in a very efficient way, and he ensures that all of the nutrients that the seed needs is there in the soil, and it's good soil, and the rain comes, the sun shines, and the farmer does everything that he's supposed to do to make sure that that seed germinates. Well, if he does that ongoingly, then there will come a time where there will be a harvest where he'll be able to reap what he's sown. And it's the concept of seed time and harvest time is just a universal principle that can apply to so many different things in life, in terms of, if you invest in your kids from a very, very young age, it's more than likely that as time moves on, that you will see a positive output from all of that investment. Now, sometimes there are things that can happen beyond one's control, where things may not necessarily turn out the way that you would like. But what you're trying to do is you're trying to put the odds in your favour, and that's what a farmer does. He's trying to put the odds in his favour. Now, there are things that can happen sometimes, external factors, like if there's a drought, so there's no rain, or the farmer's land has been infiltrated by toxins from, there's a flood from a neighbouring village and toxins are brought into the farmer's area, then that can, so sometimes there are external factors that can happen, but what you're trying to do is put the odds in your favour with what you can humanly do. And so that with trading, if you have an edge, and again, this is very important, a lot of things that I'm talking about are based on the presumption that you already have an edge. So if you have an edge and it's been proven, you simply need to take each trade as you're supposed to. You're supposed to trade to the methodology as you're supposed to. And regardless of what happens in the short term, as those negative results or disappointments, but if you just keep plodding on, being very methodical, being very consistent, very disciplined, then it has to turn. That harvest time has to come. You cannot have an edge, a positive expectancy, trade in quality, trade consistently, trade in a disciplined fashion, and it's just constantly negative. If that happens, then that demonstrates that there is a fundamental issue. Maybe the edge that you have doesn't exist anymore. Maybe the win rate that you thought your system had, maybe there have been market changes where that win rate is no longer what you thought it should be, is no longer where you thought it would be. Okay? But if things are consistent in terms of what you're doing, then there has to come a time where there has to be a takeoff. It's like a ship that's moving from a stationary position, or a train that's moving from a stationary position. There's a tremendous amount of energy that goes on in terms of kinetics in getting forward motion going. But once that motion is in play, then it doesn't have to use as much energy to maintain that level of momentum. And that's the same thing with trading, is that, when you're trying to overcome the psychological challenges that are holding you back, it's a tremendous amount of effort to break through. But once you've broken through, then you find that things are a lot more manageable. I'm not saying it's a lot more easy, because there are still times where I will have my challenges during the day, but that experience teaches you how to properly do a lot of introspection in terms of understanding where you are positioned at that moment in time, and in terms of how you react to what's happening, so that you're not making the same mistakes that you used to make before. Accepting defeat, and this comes down to a particular mantra I have, which is it's not about the battle, it's about winning the war. And the fact that there are going to be days where you just have to hold up your hands and admit that you're not going to win for that day, because if you push it, you could do a lot of damage. And what I wanted to do is just play a clip from this particular mantra I have, which is on my website. Now, I'm all over the place now, so just one moment. Here we are. Right, so on my website, towards the bottom, I've got this thing which says the key to success in trading is the ability to accept losing a battle whilst knowing you are winning the war. This wasn't something that I came up with. It was something which I actually found on an interview that was involving Dan Shapiro. So let's see. Here it is.
The problem a lot of traders have is just they can't accept defeat. Okay, and there's a bigger, there's a big picture there. Okay, and you go back into the theory of war, right? There's plenty of battles that are lost, right? Plenty of battles. Battles are lost all the time. The most important thing is to win the war. So I could lose a battle, right? I could fight with Tesla, and there's a reload seller sitting there at the top of the range, And the guy won't let go. The guy won't let go. And you know what? I'll figure that part out. Once it breaks the range, I'll get out. I'll take my loss. But I'm not going to lose the war on one trade. And I see it all the time that many traders are so fixated about being right instead of fixated about trading properly. And that snowballs into day after day after day until they realize, you know what, this is just not for me. And the saddest part about the whole trading cycle is most people will never trade up to their potential, okay, because they won't give themselves a chance to playing those premium hands. And they take everything to heart, and they believe that everything they do is the result of bad things, just everything bad. Somebody just has this evil eye on you. And the reality is, you know what, the market most of the times won't give you what you want. Most of the times it won't celebrate your existence. All the market wants to do is take your money and take your confidence. Because remember, I could go on, and this is a very important point. I could go on a run 3 weeks in a row, right? 3 weeks in a row, have a magnificent run. And this is how fragile us traders are. You can go 2 days without making money, and you've completely lost your confidence. Think about that. Think about how many times traders have done that. You could go on a 3-week run doing the same thing every day, every day, every day, every day. You lose money 2 days in a row. You start questioning everything you did for your whole career. Okay? And I say this.
I really love that clip by Dan. And it's so true. It's so true. The fact that you could be on a really, really good run, and then as soon as you hit a trade in a day of loss or 2 days of losses, you actually start questioning your strategy. You start questioning everything you've ever done throughout your whole trading career, and that's because we attach a lot more value to loss than we do to wins, and it's just human nature that we do that. Okay, so the other point I just wanted to raise was in terms of dealing with losing days is risk management. So what helps me again to deal with losing days is the fact that my risk is limited. Yeah, my risk is limited. So basically, all over the place here. As I said, these webinars are going to have warts and holes until I properly manage how to do them without sort of being all over the place. Okay. So risk management just basically means that I know what gives me comfort is I know that I have a predefined maximum cap on how much I'm willing to lose per day, and that kind of gives me a sense of comfort in knowing that if I do have if I start off with a bad day, it's not going to become an account threatening day. There was a person that emailed me last week who told me how he traded recently and he had 10 losses in a row. And I was thinking to myself, well, 10 losses in a row after 3 or 4 losses, I would have accepted defeat for that day because I know that there's more trading days to come. But, if you don't have predefined risk, and you're simply just trading and hoping that the market will turn or that probability will put things back in your favor, you could do a lot of damage to the damage to your account could be so severe that you bail out in the end before the market has time to sort of go back to something that's more favorable to the trades that you're doing. So the whole idea behind having a daily limit per day is that it just gives me a cushion of knowing that, well, things haven't worked out, so there's no need to keep trading on and on. And also, the other thing to sort of bear in mind as well is the fact that I don't necessarily want to be trading sort of, 8, 9, 10, 11, 12 times a day every day, because, life goes on and I've got other commitments and responsibilities. So, if I start off with 3 or 4 losing trades for the day, I don't necessarily want to be in a situation where I'm trying to get to trade number 10 or 11 to pull things back. I'm much more happier holding my hands up and saying it hasn't worked for today. That's just the nature of the beast. But I know that positive days are going to come. And I know because my reward to risk is in my favor, that most of those winning days are going to be a lot more in terms of value than the losing days. So that's my approach. So dealing with losing days, this is how I approach it. And I hope this is clear, and some of these things you can take away and look into and see how it can apply to what you do. Oh my gosh, look at the time. Okay, another way that I deal with losing days is I'm quite a visual person. So this graph here is basically showing you this project began in March and there's been 63 trading days. And you can clearly see here how, in terms of my strategy, that there's a lot more winning days than losing days. And that in most situations, the winning days are, in most cases, a lot more than the losing days. And another good thing to bear in mind is that when I do have a losing day, most of the time, the clusters of winning days between losing days is quite significant as well. So for instance, on day 27, I had this loss. But then look at the next batch of days. Yeah? If I was to add each of these days on top of each other, you know, you would have a value which would be sort of going off the end of the laptop. And then I get to the next loss, the next losing day, and then I get these winning days, which again, so what this graph does, it gives me confidence in knowing that when I do get these, I mean, even the last losing day, which was Friday, which was quite, you know, it was quite severe. It was my maximum daily loss. But look what's happened since the 3 days after, Saturday, Sunday, Monday. If I added these values, individual values on top of each other, it would probably be up here, which is a lot longer in length than this. So the equity analysis is great for me. Again, it gives me confidence because it helps me to look at the bigger picture, the wider picture, so that I don't get bogged down by these individual red lines. The only time that these individual red lines would become quite a threat to me is if it was happening day after day after day. You know, if I had like 4, 5 losing days in a row, I would then obviously start to wonder, okay, what's going on? Because that's not something that's consistent in the back testing and the simulations. In the back testing and simulations, I think the maximum number of losing days was 3. And even though it was 3 losing days, they weren't full daily limit losing days. They were 2 of them were partial losing days. The other one was a full losing day. So this kind of gives me some confidence that what I'm doing is going in the right trajectory. This equity curve, this is the equity curve showing profit since this project kicked off in March. This sort of latent line here, this stationary line, was due to Easter, where I actually took about a week off because I was sort of traveling with family. But look at the way this equity curve rises. And again, this helps to manage our expectations. It's not just going to be a straight line. Look, it goes up, then there's a pullback. It goes up, then a pullback. Up, pullback. Up, pullback. Up, pullback. Up. And then here, it kind of goes a bit sideways for a period of time. Then pullback. Then growth. So you have to kind of understand that when you have a losing day, what's happening is that it's just a pullback, but the period of growth is coming. You know, it's not an equity curve which is going to be coming back down. It's an equity curve which is always going to be going up, but it will have pullbacks because that's the nature of trading. And you've got to understand that's the cost of doing business when it comes to trading. Yeah. So hope this kind of gives you some idea as to how I deal when it comes to losses and losing days. I'm not trying to tell you that when I have losing days that it doesn't affect me emotionally. I do get sort of peed off with losses because my expectation is that I want to win. But however, the experience that comes in is where I don't do anything stupid which can damage my account even further by taking revenge trades or deciding to pile on an oversized trade or even just taking an outright bet. I mean, just to give you an example, this particular day, so just going back to my daily trading results, on the 13th of May, which was Sunday, I had decided to sort of just do a little experiment where I said, you know what, let me just try and trade the whole day and see what happens. Because normally, within 6 to 7 trades, I'm done for the day. But I thought, let me just trade the whole day because it was coming to the end of the league season for many of the Western leagues in Western Europe. And I just felt there was going to be ample opportunity of late goals because you're going to have teams that need to score to either stay up or reach a particular level of promotion or win a championship. So let me just try and trade the whole day. So I decided, well, because I'm going to be trading a lot, that is actually going to increase my risk because my risk tolerance is £300 for each day. And I don't want to sort of, start off with 3 losses and then have to. So what I decided to do, I thought, let me lower my losses. So my individual losses are normally around £100. Let me limit my individual losses to around £70, just to give me a bit more leverage in terms of how much I can undergo in terms of losing trades without hitting my daily limit. So that's why you find here that a lot of my wins were kind of around £120. Normally they're around 170 or 200, but I was lowering my position sizing for each trade. So I thought, well, if I'm going to take on a lot more trades, then hopefully, I should reach the day with, a green which is sort of exceeding or close to £1,000. And I remember when it got to when I got to sort of like late afternoon, I was only £450 up, and I remember I felt kind of deflated. I was thinking, good God, I've done all these trades and I'm only up £450. And I remember I thought, you know what, let me stop because mentally I'm starting to feel like deflated and I don't want to sort of take on more trades and all of a sudden it becomes revenge trading because I'm trying to sort of make up to what my initial expectation was for the day, which was £1,000. And so I remember I stopped trading. And then I remember sort of a little bit later on, I was doing some stuff, and then I saw that Barcelona were kind of I think they were 3-1 down or 4-1 down, and then 5-1 down against a team that it was just unbelievable how they could be 5-1 down against that team, Levante. I remember Barcelona then pulled it back to 5, so it was 5-4 to Levante, and we were just going into the 70th minute. So there were 20 minutes left. And I remember something inside me was like, put on a trade or put on a big bet. Because Barcelona are bound to score. There's no way that it was 5-1. They've pulled it back to 5-4. They're obviously riding a wave of momentum. You've only made £450. Put on a £500 bet because they're going to score. And, at the end of the day, you'll be able to hit your £1,000. And I remember I had to laugh because I remember when that thought came, I remember I laughed because I said to myself, how interesting, where maybe 3-4 years ago that would have happened and I would have just gone ahead. But something inside me said, hold on a sec, look at yourself. Look at the profit that you've made for today. Look at the risk that you're taking on. Look at the fact that it's going outside your methodology. It's going outside your framework. You're going outside your discipline. These are the things that can kill you in terms of trading and stunt your progress. And I remember I simply just turned off the laptop and watched the game. And what happened? Barcelona didn't score. It ended up 5-4. Can you imagine how demoralized I would have felt if I'd done something really stupid, believing in certainty that something was going to happen to justify me putting on something that would have been just absolutely ridiculous. And so the reason I mention that is just to let you know that I do have challenges on a daily basis. Sometimes curveballs come, which I didn't anticipate. And you've got to just be resolute and be somebody that understands it's the necessity of sticking to the game plan, because that's the only thing that's going to keep you insane, and it's the only thing that's going to protect you from whatever the market or whatever environmental factors may throw in your direction. Okay, so let's go back to the presentation. And I know that I've probably completely bypassed the time that I was supposed to be doing in regards to this. Okay, the law of large numbers. Now, we're starting to get into the meat of the topic. Now, the law of large numbers is something which is a scientific fact. However, this is something which probably was one of the main reasons why I wasn't able to have any growth in terms of my trading, because I was actually stuck not knowing what to do. And I'll explain to you what I mean by that. But the law of large numbers simply means that the more occurrences that take place is the more that the results will actually move towards the mean of what that probabilistic mean is supposed to be. So as an example with the coin toss, if you toss a coin, if you toss it 10 times, it's likely that you could have 7 heads or 7 tails, or even 8 heads or even 9 heads or 9 tails. But if you was to toss that coin 1,000 times or 100,000 times or 1,000,000 times, what you would find is that the balance between the tails and heads would be very, very close to 50-50. So the law of large numbers is basically saying is that the more you do of something, the more that the results are going to head towards the direction of what that probabilistic expected mean is. And that's why high frequency trading systems, hedge funds like Virtu or RSJ, do tremendously well. I mean, RSJ is an example. I mean, they're a financial group that operate in derivatives, and basically, there was an article that came out in the Times a couple of years ago, and it was quite interesting because if you look at this article, it says, how does RSJ achieve such incredible returns in a closely guarded secret? In common with other algorithmic traders, the firm jealously guards its secrets, obviously. But it basically talks about how they use advanced statistics and the law of large numbers to beat the market. And the way it comes down to it is that obviously we talked about a 50-50 situation. But the way that RSJ work is that they have an edge which gives them 50.5 to 49.5. So they have a 0.5 edge. But because of the fact that they're actually doing millions and millions of trades a day, that 0.5 edge, 0.5% is enough to make sure that they have profitable days most of the time each year. So the law of large numbers is a very, very important and scientific fact. Yeah? But the problem that I had was the fact that, and this is a problem that you're probably thinking, well, how does that apply to us as a lone trader? Because as a lone trader, you have limited capacity. There's no way that you yourself can trade 1,000,000 times a day. We can't trade 1,000 times a day. We can't trade 100 times a day. and some of us will struggle even to trade 10 times a day. So if we're supposed to be trading a lot of times in order for our positive expectancy to come through, then isn't there a bit of a paradox because of the fact that we can't trade as many times as a high frequency algorithmic system or a hedge fund? So this caused me a lot of trauma because I remember I used to try and take on strategies where I would try and trade 20 times a day. And basically, by the time I reached trade 12, trade 13, I was mentally fried and mistakes started to creep in. And it also put a lot of tension in the home because of the fact that I was constantly checking markets. And, if the missus wanted to go out or wanted to go out here or there or take some family members out, it was always a problem for me because I was always conscious of the fact that I didn't want to be driving when particular trades needed to be executed. And so in the end, my comfort came when I realized that what I had to do was operate like a sniper. Now, it's really interesting understanding how a sniper operates because there's 3 key characteristics that snipers have. Number 1, they have an unwavering amount of patience. And this is something which I actually remember seeing in the movie The Bourne Identity. I can't remember if it was the first one or the second one, but I know there was a particular scene where a sniper had been sent to basically shoot down Jason Bourne. And I remember the sniper was perched on top of a building, on the roof of a building, and he was actually sort of looking into an adjacent building where he had seen Jason Bourne. And I remember the sniper looking to basically take the shot, but because of the fact that the conditions, the angles and the movement by Jason and the fact that there may have been some other people around Jason, because of that, the sniper decided not to take the shot. And I thought to myself, remember watching this thinking, goodness, as a sniper, you must have a lot of patience to be a sniper because of the fact that you're in a role where you're really looking for precision and you're looking for all of the stars to line up in order for you to be able to execute and take advantage of the skill that you have. And I remember when I used to do paintballing. I remember we did paintballing in East London a few years ago. It was one of my friends' birthday parties, and we all went paintballing. And I remember it was quite funny actually, because I remember when the scene started, and basically we had to try and sort of defend. We had a particular treasure chest, and we had to defend it from the army that was invading. And I remember as the army were coming towards us, which was obviously a second group of guys that were coming towards us, and I remember we sort of went crazy with our guns, like machine gun fire, like trying to shoot. A lot of the times we couldn't even see where these people were because they were kind of camouflaged behind trees, and we were just shooting. And it was so funny because as I was shooting, and I then ran out of bullets, and then I remember looking to my left, and I remember I saw one of the guys who was actually part of our team, and he was perched on a tree. And I remember when he was taking his shots, it was just one shot, probably one shot every 10, 20 seconds. But he was taking out so many people. And I remember speaking to him afterwards, and I got to learn that he was actually somebody that had experience doing shooting as a fun hobby and as a marksman. And it was just interesting because he was saying that, it's so important to have the mentality of a sniper because of the fact that number one, you're not wasting bullets. Number two, you're not shooting randomly, and number three, you get a lot more reward for the risk of bullets that you're losing. And it was quite interesting because it showed me that as a sniper, not only do you have to have an unwavering amount of patience, but you also have to have mastery of your tools. And also you have to have the ability to remain, consciously in control of your mind and body for long periods of time in high stress situations. And this sniper strategy was something which helped me to understand that when I'm trading, I can't just go out there on a daily basis trying to trade as many times as I can, thinking that probability will help me through. Rather, I need to leverage probability as a window of opportunity to extract the profits that I want, because I know that probability can change. And what used to happen in the past was that I would, get myself into a situation where I was up, had some profit for the day, and I would just trade and trade and trade, because I'm thinking to myself, well, if I can trade 20, 30 times a day, then look at the profit potential. And then what would happen? I would be up £300-400. I would be back down to zero, and then 300 and 400 pounds down in the red. And then I would continue to trade because now I'm trying to get myself back to break even. And before you know it, I've mentally fatigued, and I end up with a loss for the day, or break even, or just a small profit. And I remember thinking to myself, I can't consistently trade this way on a day-by-day basis, because of the fact that if I was living on my own, then maybe. But I need a much more precise way to trade. And this is where the whole sniper strategy comes in. So it's not really about abusing probability. Yeah? Because just because you have a system that wins 70% or 60%, it doesn't necessarily mean that that's going to be the win percentage every day. And you have to really kind of take into account your mental state and how much you can cope with mentally with trading. Because the thing about trading is the fact that, when I go into trading, I'm not just, especially with late goals, I'm not just going in and placing a trade. Probably for the first 20 minutes, from the 70th minute onwards, I'm watching price and I'm looking at momentum, and I'm trying to sort of develop a justification for being able to take the trade. So, if I'm making 6 trades a day, that's 20 minutes times 6. That's a lot of mental exertion. So imagine trying to do that 20 times a day or 30 times a day, trying to trade 20 times a day, 30 times a day, and then timesing that by the number of days in a week. Yeah? And the number of weeks in a month. It can be very easy to approach burnout. And when you're mentally fatigued, that's when more mistakes come in, and your whole emotional balance sort of is very much out of the picture. But as a sniper, the sniper strategy also helps you to understand when to run your winners. Yeah, when to run your winners. So there are times where you can trade on, because what you're trying to do is take advantage of pushing your winners. And I always used to try and wonder, what does it mean to cut your losses short and run your winners? Because I couldn't see how that applied to trading in football. Especially when you've got a defined loss and a defined win, where my win's always going to be around 1.8 times more than my loss. So what does it mean to run your winners and cut your losses? Because my losses can't be cut. My losses are most of the time always going to be £100 if I'm using £100 as liability. But the way I apply it is more to the day. So with a day, on a daily basis, I can limit my losses for the day. And on a daily basis, I can push my winning profits for the day, dependent on whether I have a premium hand. Now, a premium hand... Now, before I talk about the sniper strategy in more detail, let me just play a last clip which talks about, when I say premium hand, what am I talking about? Okay.
And what happens is when you're trading well, okay, if you look at your P&L and you say to yourself, well, my goal is $1,000 for the day, okay, and you hit your goal within the first hour or so, and then I know a lot of traders, they'll shut off their day, right? They'll completely shut off their day and they'll leave. Here's the problem. The day that you can make their 1,000, 2,000, 3,000, 5 grand, whatever it is, whatever interval you trade, whatever tier size you trade, the day you can make that money really, really quickly, you don't realize it, but you're playing a premium hand. You're playing the kings, you're playing the jacks, you're playing the aces, you're playing the queens, okay? So that day is turning out to be a premium hand. And what you're doing is you're taking a pair of aces and you're putting in a bet of $50. That's basically what you're doing. And you're telling the guy on the other that's playing against you, I'm all in for $50. And once you hit that pot, you say to yourself, okay, I'm done for the day. So you're losing out on a premium hand. Every professional trader will tell you, what we're looking for is premium. We're looking for those pocket aces. Okay, so the day that you can make 2, 3, 4, 5 grand for the first 30 minutes, 45 minutes, you're in a very, very bullish scenario, playing a premium hand. So the last thing you want to do is say to yourself, well, I'm up a grand for the day, I'm done. And you don't realize that 1 grand could turn into 3,000, could turn into 6,000, could turn into 10,000. Because you're riding that euphoric hand. You're riding those pocket aces. And I don't...
Okay, so Dan Shapiro there is talking about premium hand. So premium hand just basically means where you're starting off very strongly for the day and it's giving you enough leverage to push on further, knowing that if things change in terms of the market, it may slightly dent the profits that you've got, but you still end up overall with a profitable day. So when we talk about premium hands, we're talking about it within that particular context. So going back to the presentation, what I do when I trade on a daily basis, I have this 3-strike rule that you find in baseball. So if I start off with 3 losing trades, I'm done for the day. I'm not even going to think about trying to recover those losses back, because most of the time when I try and do that, all I'm doing is digging myself a big hole. Now, is it possible that after 3 losing trades I could have 3 winning trades? Absolutely. However, I like to work with what I call defined risk, so I know what my maximum defined risk is for the day. If I keep trading on, then that risk could turn from £300 to 500 to 600 to 800. And why do that? As we talked about earlier, we talked about the difference between battle and war. I'm happy to lose a battle because I know that I'm winning the war. And I know that my positive expectancy will bear out over time. So I have this 3-strike rule. Now this kind of gives you an example of how my losing days would result. So a losing day can be 3 losses in a row. It can be a win followed by 3 losses in a row. So basically it's any situation whereby within the first 4 trades I've lost 3 times. My premium hand days are where within the first 4 trades of the day I've won 3 times. Because you've got to remember, my wins are normally around 1.8 times larger than my losses. So if I've had 3 wins in my first 4 trades for the day, then it puts me in a very strong, profitable position. And then the other category is what I call proceed with caution days. So these are where in my first 4 trades, it's kind of 50-50. I've won twice, I've lost twice. So I'm still profitable. But I need to bear in mind that if I continue to push trading, I could end up with a 0 balance, because all it takes is for a couple more losses, 2 or 3 losses to bring me back down to 0. So categorizing my days into battle losing days, premium hand days, and proceed with caution days gives me a framework to work with. So I'm not just trading aimlessly going forward, but I know what I need to do based on how my first 4 trades go. And normally what happens is, with my premium hand days, normally what happens is once I go to trade 5 and trade 6, I sometimes cut my position size in by 50% in terms of moving forward, because I know that if I was to basically have losses coming my way for number 5 and number 6, then it wouldn't place too much of a dent into the profit that's already there. However, if I extend to number 5 and number 6 and number 7, then it's just like additional profit that goes on top. So it's sort of like a win-win situation, in the sense that if you try to push that premium hand and it doesn't go the way that you want, then the impact on what you've already got in the bank isn't too much, because of the fact that your position sizing has been cut down by 50%. So what it would mean is that if the liability is £100 normally, then the liability would go down to £50. With the proceed with caution days, what tends to happen with those is that if by the time you get to the fourth trade and it's sort of like a 50-50, depending on the situation, sometimes I would stop, or secondly, I would probably take the 5th trade at a 50% position sizing, so 50% reduced position size in liability, and if that goes fine, then I would take another one, and so you're sort of doing a drip feed one by one until you hit like 2 losses in a row, which is for me a signal to say, okay, time to stop. So there's a number of ways that you can approach to proceed with caution, but the whole idea behind this is to give a framework of how to approach your day, rather than just aimlessly ambling on, not knowing how to react to what's happening. And this is something that really gives me a framework. It gives me some context to deal with, and that's how it has helped me along. So hopefully that helps those that are listening on the webinar. So this is the end of the presentation. So I hope those that are listening, you've enjoyed what you've heard. Basically, because time has gone, I'm not going to be doing any questions. Hopefully what I've talked about today has managed to address some of the questions that you may have, but certainly feel free to email me if you've got any